Welcome back to another episode of FPO&G, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about why we think oil and gas retirement is about to pick up. Justin, get your tinfoil hat out. This is, us just unpacking a theory, right? And we'll kind of talk through why we think it's the case. But Justin, before we talk about, are the reasons why, I would love for you to talk about the last kind of year and a half and your theory as to why retirements slowed down, by the number of, and what we mean by that is the number of people retiring from oil and gas companies.
Jared, that's a perfect place to start. And I will actually take us a little bit further back. So, the premise of this is that you and I had a discussion, and this is about 2.5, 3 years ago or so. And, we made the prediction that we are not going to see people retire from oil and gas companies. By and large, retirement is really going to stop. And we kind of thought that it would stop until about 2025. And so here we are. Now, the genesis of this is really 2015. And so 2015, what was it? 2018 and then 2020. There are 3 oil crashes in a 5-6 year window during that time. So, we saw reductions in force. We saw rifts happening at super majors back in 2015. Then a few years later, it happens again. And then in 2020, obviously, oil goes famously negative. We have basically every oil and gas stock cutting in half or worse. So just an absolute bear market of, historical uniqueness and magnitude in 2020. And so, Jared, let's recap what happens there in a 5-6 year window. There's 3 major negative events for the industry. And so, anytime an industry goes through turmoil, you typically get layoffs, you get severance packages, you get any sort of indication of interest, reduction in force, whatever the official terminology that each specific company likes to use. And so those events effectively meant that a bunch of people retired. At the end of the day, if you are 61 and you get riffed and your job is no longer there and you get a severance package, a lot of people really face this situation where, Jared, whether they wanted to or not, whether this was their financial plan or not, they had to retire. And so, right now in the timeline, we're camped out here in about 2020. So, Jared, now let's fast forward 2 years, and it's 2022. And what we have is interest rates go through an absolutely historic, let's just say, kind of few months, certainly a historic year in the bond market. One of the worst bond crashes in generations. But Jared, if we just think about the impact on oil and gas, super major employment, and kind of the landscape of who is retiring from oil and gas companies, this is the last major event because interest rates just explode in value. And anyone listening to this, you're probably well aware that, when an interest rate goes way, way up, for a lump sum pension calculation, it makes the number go way, way down. So inversely related, interest rates jump up, pensions, at the snap of a finger, pension values drop in a way that has almost never happened before. And so, Jared, the result of that is if you are sitting there and it's 2022, you are staring at your pension value that is about to drop by potentially hundreds of thousands of dollars. And so if you were planning to retire in late 2022, in 2023, or even in 2024, you're looking at your pension value and you're saying, no, I have to retire right now. And if I don't retire right now, I will be effectively working for free for the next 2.5 years. That's how big the fall in pension values was at this time. And so, we go back a decade and kind of fly over the different oil crashes, the different severance packages that were, happening at companies just left and right. And then that interest rate event after those 3 difficult, industry times what it resulted in is that a ton of people retired. And then specifically with that 22 event, it pulled forward anyone who was going to retire in, 2022, 2023, maybe even 24. They all did it kind of in that first half, Q1, Q2 of, I think that was 2022. And so, Jared, the result of that is, for years, no one really retired at a normal clip. And so obviously there were exceptions here and there. But I would say that if we could talk to an HR department at every super major, I would say that 2023 and 2024 probably saw a tenth the number of retirements that those HR departments saw in 2019, 2020, 2021. That is what I would guess. It was that big of an event. So that's kind of a long, rambling history of the past decade and where super majors have gone with employment, with pension packages and severance. Where should we go from here?
I think just to restate what you're saying. So you're saying volatility caused, reorgs that caused severance packages. And then you're also saying, hey, interest rates moving up as astronomically and as quickly as they did, created this weird calculus of, and I remember helping clients with this, just like, how much do interest rates have to rise for your work for the next 12 months to be for no money? Yeah. And right, like we had no idea where interest rates were going, but there wasn't, because we were starting off such a low base and the velocity of interest rate raises were so high. It didn't take much in terms of rising interest rates, especially, for our lifelong super major employees that had substantial pension assets. So you're saying, hey, a lot of the volatility and then also the rise in interest rate kind of accelerated, right? Because we'll talk about this later, but there's different people on different places of the fence or maybe the finish line of that is retirement, right? Some that are right up to it, some that are already past it, really just working for other reasons, and some people that aren't even close to it, right? So, and we'll talk about those people later. But what you're saying is, hey, when this happened, anyone that was, within probably a mile or two of the finish line sped up really quick and ran faster to get across the finish line. And because of that, there's this weird lag in the race, if you will, where there's not a lot of people retiring.
Jared, that's well put. And I would actually add something to that. I love the way you phrase this, that any super major is looking at their workforce and, they're trying to figure out, okay, who is going to retire? When are they going to retire? And by the way, this has massive implications down the line. When people are regularly retiring, that also creates upward internal movement for professionals at a company to be able to get promoted. But Jared, what we had after those three kind of oil industry crashes, if you will, so after 2020, there's no one still at those companies who is kind of past where they expected to be. A ton of people got severance packages. And so at any given time period, there's usually some people who are just planning to retire that quarter. There's some people who are going to retire sometime that year, but there's also usually group number 3. And it's people who were actually thinking, I might retire like a year ago, 2 years ago. And for whatever reason, they're still with the company. Because of all of those crashes and severance packages, that third group wasn't even there in 2022. And then anyone who was going to retire or might retire in the next year or two, they all, just like you said, they ran to the finish line. They immediately retired.
Yeah. So as spectators of this retirement race, it's been a little slower this last 12 months, right? Plenty busy for us as a firm, but yeah, I would agree that it has slowed down. So the first piece, if I'm going to sum it up and put a nice bow on it, the reason why we think oil and gas retirement's about to pick up, because there was an accelerated lull, right? There was a lull that was after the acceleration due to interest rates and kind of a few crashes that really kind of threw everything off course. So just kind of
for 2 years, no one retired. For a good 2 years, maybe more, no one retired.
Yeah. So now the people may be contemplating that retirement decision, right? When interest rates were moving up, if you were 3 to 5 years out from retirement, it was what it was, right? If you have 3 to 5 years of employment, 5+ years of employment income, interest rates could go up even a crazier amount and you'd still probably work because especially, at retirement, your high income, your earning years become substantial. So that totally makes sense. I think the other thing that we need to think about is like, I would call it like the pressure of oil and gas companies to do something, right? And like
Mm,
what I mean by that is like if you look at oil and gas, like valuations, like they're lower. We talked about this in a past episode. The stocks haven't really done well.
yep.
And so like it's like, hey, what are you gonna do? Right? Like how are you gonna get Wall Street excited again? And there are only four things, but I came up with these four things that I think you can discretionarily spend on, right? You could spend on CapEx, you could spend on shareholder yield, what Matt Faber calls it, which is buybacks and dividends. You can buy other companies or really people, right? Like a lot of the other costs, especially in an infrastructure heavy business like oil and gas, like those are kind of like fixed costs. So those are really those are like the four things. Justin, is there any ones you would add to that, or any thoughts you have on where we should start in terms of those four?
I love those four. And Jared, a couple notes on that. One, interesting to think about those four because it reiterates what we say as investors, you're investing in future cash flow. And so Wall Street and stock prices really care about future revenues, future profits, future cash flow. That's what you're paying for. And then also interesting, love that Meb Faber description, shareholder yield, because that encompasses two things that are kind of the same thing in a sense, both dividends and stock buybacks. So interesting to kind of dive in there, but love it.
And I guess, right, like I guess the point we're going to make is, hey, these other three have inertia to get. So if you think about a company having $1 of earnings and they can spend it in one of these four buckets, we're going to make the case that the other three buckets are more likely to get the dollar than people, right? And so I think one of the reasons why, CapEx, I think is going to be interesting over the next 5 years, 4 to 5 years. I think we have an accommodative policy regime in Washington, right? Drill,
Yeah.
baby, drill. I think, and oil's kind of like flatlined, right? It hasn't really had any breakouts up or down anyway. So if I'm a company thinking about investing in CapEx, I think I have a regulatory tailwind that I might not have had at any time over the past 4 years.
Fair.
So I'm more inclined to invest those dollars than I might have been 3, 4 years ago, or even 2 years
Possible.
ago.
Yeah. Very possible.
So if I'm a corporation, I'm thinking of, hey, CapEx could be compelling. I might save more for future CapEx, right? And that CapEx is going to be more cost intensive because I'm probably going to debt finance a good portion of it, right? Because of how delayed the payback is, depending on, of course, the infrastructure you're investing in. But
Yep.
generally speaking, it's delayed. Okay, two, I think buybacks and dividends, right? Like it's tough to wind that down once it's ramped up, right? And I think like especially like oil and gas like isn't a darling of the S&P. It's like a small, it's a smaller piece, kind of like what we talked about. Like stock performance hasn't been great compared to the S&P last year, right? It's not FANG, it's not Mag 7. But one of the things that oil and gas companies are great at is returning capital to shareholders. So super major buyback and dividend repurchase was $113 billion in 2023.
Wow. That's incredible.
And that's just ExxonMobil, Chevron, Shell, Total, and BP,
Wow.
right? So like if you add all the, midstream companies, E&P, right? Like multiples of that probably. But all that to say, once you've kind of let Pandora out of that box, it's tough. Like if you're going to slash a dividend or reduce buybacks, that's not a message of optimism to send to Wall Street, right? And when
That's
you're
right.
kind of when you're in the penalty box in Wall Street's eyes, once you've started doing that, it's really tough to correct course without signing yourself up for significant short-term pain
That's right.
from a price perspective. And again, right, like I might argue from a capital discipline perspective, it's totally reasonable to dial those things back if you can strategically deploy them in the other buckets. But just from a messaging perception, what's going to happen to your stock price short term, which impacts compensation for a lot of these executives, that's probably something that's going to put downward pressure on the stock price.
For sure.
Okay. And then the other thing, acquisitions, right? So you could buy other companies. And we've seen loads of that.
Seeing a
And
lot
even
of that.
seen a more of that, right? But the reason you make an acquisition is to diversify your asset base, geographical diversification, maybe acquiring a new business line, or the beautiful word, which I'll use a direct quote from a CEO later, synergy, right? And like pretty much no, like companies at that size are not making acquisitions to acquire talent; they're acquiring assets, right? And hoping
Yep.
that they can reduce redundancy and get a dollar of revenue, diversify that work away, and then only pay 50 cents on the labor versus the dollar that the other company was paying, right? So
But
in some,
another,
yeah, go
to
ahead.
put it in another way, Jared, effectively, business A buys business B. They now have all of business B's assets in all of their different operations. But business A does not want to continue to employ 100% of business A and business B's people. And they're confident that they can keep operating and continue to thrive with everything they just bought with something less than 100% of that workforce.
That's exactly right. So really the case that I'm trying to make here with the second point is, or all of these points is, there's a finite number of places you can discretionarily allocate capital to. And for the reasons I mentioned, there's probably more excitement and energy the other thing about acquisitions, right? Everybody's doing it. It's kind of the thing right now, right?
Yep.
And again, getting back to point one, there's a climate where more likely to get deals through the FTC, or there's a perception of that, and everybody's doing it, right? So again, the pressure of Wall Street to do something. A lot of these firms that might have been on the fence the past few years about making an acquisition, now could be the time to do it because the old adage of hey, do something. Hey, we want to see you do something could lead to an uptick there.
Jared, think about the podcast we had last year with Bob Phillips. So Bob Phillips oversees a $7 billion sale of his business to Energy Transfer. And he mentioned this on the podcast that at the end of the day, they're looking at the landscape of their business, where it fits in the industry, what the next decade looks like. And size is a major concern for them. And it was in their best interest, emphatically, to go through and complete a sale to Energy Transfer to get some of the, scale and some of the synergy, to use the buzzword. They really had to do it to keep up with the changing landscape of where their place in the industry was moving forward.
Yeah, no, absolutely. So I think for all of these reasons, like the landscape is changing, and I think there's a huge opportunity set, right? Like I think like it's kind of like a blank slate where like I think things are going to get really interesting over the next 4 to 5 years. But all of that to say, from a macro perspective, I would say I'm pretty bullish. But from a personnel perspective, things status quo, employees just kind of doing business as usual, I think there's going to be, again, layoffs will be part of it, but I think velocity of change will pick up, right? That means people getting promoted. That means people getting severances. That means people switching companies, right? Like I think velocity of change is going to increase. So like, I think you would probably agree. We're both bullish on the industry, but it's about to get interesting from a human capital perspective.
Absolutely.
Awesome. And so all of this leads to cost cutting being the lowest hanging fruit, right? And like, I think we're recording this in January of 2025, right? Exxon, like last year, Exxon made a big acquisition. Chevron made a big acquisition. ConocoPhillips and Marathon, right? Like
Yep.
there's a lot of activity, right? All of these things lead me to believe that, right, there's going to be a lot of elimination of redundancy. I want to read this quote from ConocoPhillips CEO because it just highlights exactly, like it gives us the playbook. Marathon Oil adds high quality, low cost of supply inventory adjacent to our leading U.S. unconventional position. We have a strong history of seamlessly integrating assets, and we expect to deliver synergies of over $1 billion on a run rate basis in the next 12 months.
Wow.
That's the playbook. Like, what's the value unlock? Synergies, right? And I see that as reduction, consolidation, streamlining of workforce.
Absolutely. And your premise at the beginning of this is that oil and gas stocks, have not necessarily been the darling of Wall Street. And so there's kind of this sentiment that they have to do something, and merging, acquiring, and then cutting expenses via workforce reduction is a way to do that. It's a way to tell Wall Street, Jared, that our future revenues, our future cash flows look good.
Yeah. And that's the thing is like the earnings equation is really simple. I can grow my top line or become more efficient, right? Like there's one way, like the way I make more money, I increase EBITDA is like I increase my top line or I cut my costs. And so Justin, like, what does this mean? So like we've kind of outlined our reasoning for why we think retirement is going to accelerate in energy. Like, what does that mean? And I think it might be helpful to go back to like, and the message is probably a different one depending on, talking about the retirement race we're running. Like, where are you in that process?
Great point. So it does mean that there are likely going to be some severance packages happening again. We're already seeing some companies announce a reduction in force. I think you mentioned BP, Chevron, looking at receiving expressions of interest from their workforce in the coming months. They haven't completely delineated when this will be, what exactly that will look like, but they've made it known that expressions of interest will happen at some point. And so, just like you said, we're going to see more people retire, and that is going to be starkly different than the last 24 months or so in the industry. More people are going to be retiring, and we're going to do an entire episode, Jared, on how to figure out really the readiness equation. And essentially, I think a good place to label that podcast, a good way to label it, is that if you're sitting there wondering, should I raise my hand at Chevron and express your interest? There are some things that you need to know about your own financial plan, about your cash flows, about your expenses. And so we want to dive into the weeds and help kind of provide a little bit of maybe a metric, of a filter to help you understand whether you're ready. But Jared, I also think it just has huge implications down the line in the workforce. At the end of the day, if you are thriving in your position now at a major or super major, and you're potentially going to see 1,000+ people retire and move on, well, that can create some opportunity internally and throughout the industry.
That's exactly right. And that's why it's like, it's not all going to be reductions. It's velocity of changes in employment, right? Which isn't necessarily a bad thing. I just think the deck is going to get mixed up. And I think that can be good, can be bad, can be neutral, kind of depending on really where are you in this race? What are your goals? Why are you running it? And what is your opportunity set? And Justin, like there's a couple demographics that you haven't really mentioned, but that are kind of less impacted, right? Like, and you touched on this earlier, but like there's a first category that's already actually finished the race. They're just kind of running for brownie points, right? And like this person is like already financially independent. And like the reason they're continuing to work has nothing to do with money because they've already reached their financial independence number. So like it could be intellectual stimulation, it can be camaraderie, or it can be inertia, right? Like I'm just working because I don't know what else I would do, and like it's a big change, right? And so for that person, like I don't think this really changes anything for them, business as usual. But again, right, like some of the velocity of change in employment is going to be reduction in workforce, right? And like that could be a toxic environment to work in if you're on a team that there's going to be substantial layoffs, right? Culturally, like that could be really damaging, right? So now if you're in that first bucket, I would say now's a good time to remind yourself of why are you still running the race, right? And if it's for camaraderie and the people you like leave, or if it's for intellectual stimulation and you end up on a project or an integration you don't like, right? Like these companies are going to change. So I think now's a good time to remind yourself, hey, why are you, you've already won the game, if you will. What's your motivation for continuing on? And as, your role, the team, the culture changes with all this change happening, just make sure that, you feel good about it. Because again, you've already won the race.
Yep. Well put.
There's also a second category of like people who I would say they're right at the finish line, right? They're like, they're at the end of the race. They're like close, right? And like for those people, I would say like this might be kind of ideal to get you across the financial independence hurdle, right? Because like severance is much more economically compelling than just leaving on your terms, or it can be depending on how high ranking you are, what compensation, stock compensation you can negotiate on the back end. So absent that, I would say generally severance, can be more economically compelling. So a lot of people, that might be the thing that just pushes them over the finish line. So like you said, like there's probably a group of people where you should absolutely be raising your hand if you know you're close enough and you're ready.
Great point, Jared. If you are ready to retire, or an ExxonMobil example, interest rates moved a little bit, which again caused pension lump sum values to decrease here in the upcoming quarters. So if you are absolutely retiring, well, it makes sense to take advantage of a more attractive interest rate and pension value now. Or the Chevron example. Yes, if you are planning to retire, well, by all means, if you can, take an election and express your interest and receive any sort of severance, that's icing on the cake. But Jared, this entire demographic, it's really, I think the mark that is true of them is that they are just now hitting financial independence. And it's interesting to think that, well, I mean, how much can 24 months really change things? So, if you go back 2.5 years and they chose not to retire when likely their pension value was going down, well, what in the world could have changed in 2.5 years? And Jared, the answer is a few things. Well, their equity compensation is drastically more vested today than it was. 2, 3 more years of earnings is a big deal. Oh, and Jared, what did the S&P 500 do over the last 2 years?
20% plus up years. Yeah.
Yeah, just incredible positive years. And so you had kind of at the end of your career, if you're in this demographic, this enormous asset bump that the market's given us these past couple of years, in addition to more equity vesting, in addition to other benefits, coming through. And now the final piece of the puzzle could be another severance package. And so, yeah, I think there's going to be a lot of people in that boat that they are just now hitting financial independence. And that means that it's time to move on.
Yeah. And you talked about I'll call it the fourth group, but like people that are really early in their careers feel pretty secure in their jobs, but this shaking at the top of the tree is going to create opportunities for them. But there's also like a third category of people that, like we talked about earlier, 3 to 5 years. So like a bump in interest rates isn't going to be the thing that moves them to retirement because they're in their peak earning years. They're still a ways out. It's kind of this weird game of chicken, Justin, where like you don't want to be, if you're caught in a company that's synergizing. I feel like I just made that word up, so I might need to trademark that. If you get caught in that company, you can kind of wait and maybe get severance, but also if your part of the workforce is reduced, you're going to it floods the market with all of these employees kind of simultaneously. So how should somebody kind of think about that? If they think, hey, I might be subject to that. I'm not certain in my job, or maybe, hey, the velocity of change is happening. I might use it to take a change. How should somebody kind of think about that of not taking the first move, but also not waiting to make the move when everybody else is making the move and the employment environment might be a little bit different?
That's a great question. And I don't know if there's a perfect textbook answer outside of figuring out what's the question that we love asking. Jared, what is your ideal future situation? What's your ideal future life look like? And so it's kind of a mixture of capitalizing on your career opportunities, capitalizing on how can you pursue and reach financial independence in the fastest way possible, mixed with what's the life optimal move. And those can be different things. They can be the same thing. Not to mention it can be really different. If you interview 10 people, you might get 10 different kind of thoughts on what that looks like for them.
Justin, but here's the problem with all of this thought exercise. While it's helpful, how do people know where they are on the spectrum? Because my bet is listeners haven't even put themselves, or maybe they have, if they think about the retirement race, do they have a good understanding of, have I already, has my time already been set and I'm just adding gravy to it? Or am I close? Am I one severance package away, or am I years away, or am I closer than I think? How do you know where you fall on the spectrum?
I want to get your answer. I think on the financial sense, you need to really understand what readiness or what financial independence really means. You need to understand budget wise, asset wise, tax registration wise, health insurance wise. You need to understand every factor. And there's, 50 or 60 little details that comprise an entire financial plan. But you need to have a pulse on that. Now, Jared, what's your answer? How would you answer that?
My answer is our podcast next week is going to answer it.
There you go. I think at the end of the day, that's the answer.
Yeah. So next week, we'll kind of unpack, hey, okay, this is our theory. And assuming it comes to fruition, how do you assess your retirement readiness? And even if this theory doesn't come into fruition, I think this is a good intellectual thought exercise to think about, okay, where am I at on the spectrum? But I think that's a good place to wrap it up for this week. I think I would love to hear from our listeners. Do you agree? Do you think retirements in 2025, 2026 are going to be at levels similar to the past few years, or at an increase, or maybe even less for reasons we didn't mention? Well, I'm excited to hear from our listeners on this and to provide the retirement readiness checklist next week. Awesome. That's all we got for this time. Podcast at brownleewealthmanagement.com. We'll see you next time.